Hi everyone, welcome to this week's edition of Midweek Market Update. I'm Ashley Rosser of Victory Fiduciary, and if you've been tuning in for some time, you know that the Bulls and the Bears have been battling, and so for the past 10 weeks we've seen a pretty significant rally happening in markets finally, and it seems that maybe, possibly, the Bulls are in control. That's kind of what everybody wants to know. So today, we're not really going to make any assumptions either way. What we're going to do is just kind of discuss where we were, where we are right now, and what are potential positives and negatives that could be affecting the market. Because again, nobody really has a crystal ball. So anytime we make determinations based upon assumptions, they're just assumptions. We can do our best to make some educated guesses with the data that we have. So that is really what we're going to talk about today. And so, as I mentioned before, we've really been involved in a pretty significant rally for the last 10 weeks. So we hit lows back in May, and we've seen some pretty significant rally uptrends since then. And so what I wanted to do is just kind of take a look at where we've been. So this is the S&P 500. This is a technical chart. So if you can see all the way back in January, that's really where this correction began. Now, if you've been following us for some time, you know that the correction was not really completely unexpected. We had been talking for months about the fact that we were trading significantly above where we would expect to be based upon price to earnings ratios. Markets had been extremely bullish for really about a year, and so everybody had kind of been on the same side of the boat, and we would tell you that every time you stretch a rubber band, you can only stretch it so far before eventually it will snap back and snap back just as hard as it's pulled the other way. And so we were really waiting for that catalyst on what was going to, cause a price reversion, and that, as you know, really was the Ukraine invasion and kind of all the geopolitical strain and concern that went with that, coupled with inflation, where we came to reckon the fact that inflation was likely not just transient, but that it was going to be sticky and was going to begin to cause some issues. And so markets kind of had to reconcile all that at once, and when we saw what happened. So we saw in some markets up to 20% declines throughout the year. And so again, back in May, we hit these May, early June, and now we've really just kind of seen this like steady uphill climb. And so a couple of things have happened, though, that are absolutely worth noting. The first one being the fact that we have climbed above the 50-day moving average. It's a very bullish sign, short term for markets. The fact that that we finally kind of crossed that would be maybe our first line of support. And so you can see that it worked as a good line of support here. Just recently we crossed above it. We literally sat right on top of it, and then we bounced above it. Now the next line of resistance that we have to kind of get through, this would be the 200-day moving average. Now you can see on Tuesday we actually hit the 200-day, hit resistance, came back down yesterday, saw slight declines in the index, nothing really to be concerned about. So we're really hanging right here. So again, with today's actions, we're very close to that 200-day again. If we can actually close above this 200-day and hold it, it would actually, believe it or not, put into sights the potential to see all-time highs within the index, which is pretty hard to believe when we look at where we've been just for the whole year here. So again, not saying that that's definitely going to happen, just saying from a technical standpoint that if we can in fact climb above that, hold that, would be at least short-term bullish for the market or positive. And so right now I think it's important also to note that just kind of where we are with relative strength. We're sitting here at 68 on the scale. 70 would be considered extremely overbought, like flashing signs, and so we're very close to that. The point being is that we would not be surprised at this point to see some sort of a healthy pullback. Markets are just extremely extended. I mean, they've had a really long run here, and markets, we can't go straight forever. So a pullback to some point between here and probably maybe 4,000. We're sitting at 4,300 right now. Honestly, would be a very healthy point. It would be a healthy point to consider maybe even deploying a little more capital if you've been holding on to cash on the side. And then give us an opportunity to actually then go on to continue to gain strength. So here would not be surprised at all to see some short-term pullbacks. I think that at this point, as overbought as we are, it would be healthy. It's expected at this point. And some things to kind of keep in mind as we're kind of going through this process. Obviously, we've seen this healthy return. We're up over 14% really since the start of the third quarter, which again is pretty significant when we look at kind of where we've been. But I would say that not everything is completely rosy here, especially kind of when we look at the backdrop. And so the Federal Reserve has continued to decrease liquidity and will likely continue to raise rates through the end of the year. And so I think that we need to be proceeding with some caution here, because markets, I think, are kind of pricing in some maybe unrealistic expectations. I think markets are hoping that the Fed is going to become more dovish in their stance, meaning that maybe they'll take a step back and say we don't need to raise rates as aggressively as we are. Inflation numbers are getting under control. Maybe we can loosen up the reins a little bit with liquidity. And so I'm not really sure if that's realistic or not. I just think that if the next Federal Reserve meeting comes out and they come out and say that they're going to have to still be aggressive, that inflation numbers are still running hotter than expected, then I think markets may have the potential to sell off again. Maybe not. Again, these are just things that when we're pricing in perfection, we need to be kind of aware of potential blips. Fundamentals are still fairly weak. Economic growth, extremely weak, almost kind of stagnation at this point. So we know markets don't always kind of go in line with fundamentals. They can run and kind of like ignore them for a while, but typically, eventually, they begin to kind of come together. So just in terms of the fundamental and the financial backdrop, there's still a lot of things to contend with here. So from a technical standpoint, I think particularly in the short term, markets are showing us signs that there's some strength there, that if we do see some pullbacks, keeping above the 50-day and then moving on would again be a very encouraging sign. Now, if we were to violate the 50-day in the next few weeks, that has the potential to be we could actually go on to book new lows at that point. So this line of support that we've now established is very important for markets, so we should be watching that pretty closely at this point. And just wanted to kind of show you where we are. We haven't looked at our asset class group scores in a while. Something interesting that happened this week. Cash had actually been sitting higher than domestic equities since around February, March this year. Well, cash finally actually dropped below domestic equities. Again, a sign of strength that was kind of returning some normality to the market. Domestic equities in the number 2 position, with commodities remaining in number 1. And so the value plays here, small cap value, mid cap value, all tend to still be kind of outperforming those growth names, although growth is where we've seen the biggest rebound in the last few weeks, particularly looking at sectors. Consumer, non-cyclical, non-surprising, continues to be in the number 1. These are the things that we have to buy really regardless of price and kind of regardless of what our other obligations are. We have to buy these non-cyclicals. Energy remains in the number 2 slot. Energy has shown some weakness, although now in the past few weeks regaining some strength again, somewhere to watch. Utilities, financials remain very strong as well as industrials. So just to kind of give us a snapshot of where we are. Something else that's interesting, bonds continue to score really weak in terms of relative strength, and I actually wanted to show real quick here. I can get back. Get back to my bonds here, because bonds, as you might have remembered me saying, have had the weakest start to the year in the history. Here we go. And just to kind of show here, so Vanguard Total Bond Market Index down over 10% for the year. And so this has really been a challenge again for investors. When we look at the fact that our total bond market index, even the TIPS, which are the inflation protection securities, fixed income, down over 10% for the year. So when bonds are supposed to be an investor's hedge, kind of supposed to be a flight to safety, when we see double-digit negative returns for the year, even in those areas, just really shows the level of complication that it's been, because the things that typically work in environments like this, they weren't working. And so investors have really had a challenge. So again, haven't seen a ton of recovery yet. Our FDIH-X high yield bond has seen a pretty quick kind of reversion up, down less than 7%. Still though, when we talk about being down that much in an area that's supposed to be safety, definitely something that we should be just kind of mindful of, that it's been a challenging year for investors. We're beginning to see some positive signs that maybe in the interim we're seeing some areas of strength and some opportunities. Again, I would definitely be watching those areas that have been overbought, particularly in the NASDAQ and the S&P 500. Deploying new capital, you may find some better opportunities after we see some of these pullbacks that will likely come, just because we're at such an elevated stance at this point, kind of watching those lines of support. And again, if we can cross above that 200-day moving average, would potentially be a bullish signal in the interim, but we could actually even go on to see new highs, which would be pretty fantastic considering kind of where we've been this year. Again, nothing's in stone. These are just the kind of things that, as we make decisions, that we like to have this information that we can use to kind of help us make more educated guesses. I hope today was beneficial for you. So thankful that you tuned in to see us. And Summer School, our latest edition with local experts, where we were talking about all different types of areas, including real estate, the mortgage environment, debt and credit analysis and management, as well as estate planning, are all coming to you in the next few weeks. So they have been recorded and edited, and they will be coming out. Look for them on our YouTube channel. Again, I'm Ashley Rosser with Victory Fiduciary. Thanks for tuning in, and we'll see you next time.